Welcome back, home loan shoppers. Welcome to Chapter 5, Section 3 of this home loan shopping course. As you can see in the course outline, Section 3 is titled Getting the Initial Quote. If you just happen to stumble across this video, this is one video in a series of videos that comprise a complete home loan shopping course. If you'd like to join us, which I hope you do, look in the description of this video. You will see this course outline, and the outline is hyperlinked, so you can join us in any part of the course that you would like to. All right, let's go ahead and get into Section 3. I'm going to stick really close to these lesson notes that just popped up next to me here, and I'd like you to stick close to these, or maybe even print these out so you can use these offline. Okay. All right. Be ready for this step, because in this step, you are going to have your credit pulled and you're going to be submitting an application. If you're not ready to have your credit pulled, just hold off and come back around to this at a different time. Okay. All right. Bullet point number 1, you're going to reach out to the favorite company out of the 2 or 3 companies that you spoke with. Remember, I had you in the previous chapters led up to you contacting and selecting 3 companies that you're going to shop at. And I wanted you to introduce that variety to give you the best chance of getting the best deal. So I had you select 1 bank, 1 lender, 1 brokerage. I also mentioned that if shopping at 3 places is a little bit too much for you and you have experience doing this and you want to shop at just 2 places, well, it'll work with just the 2 places. So out of the 2 or 3 places that you spoke to, I want you to select the one that you like the best, the one that maybe seemed the most transparent to you, the one that seemed the most knowledgeable to you, the one that didn't pressure you into doing an application on the spot. Because remember, the first contact was just gathering information, just doing some recon. All right. So you're going to contact not only that company you spoke to, but the person that you spoke to. Don't start over scratch with a new loan originator. Speak to the same person you spoke to the week prior or 2 weeks prior, whenever it was. All right. Bullet point number 2 here. Let them know that you want to submit an application and get a loan estimate. Now, they can't do a loan estimate without doing an application and pulling your credit, but just let them know that you want to submit the application, because if you just tell them that you want to get a loan estimate, they might go into the whole spiel about telling you, hey, I have to do an application and pull your credit and yada, yada. You want to just expedite things and tell them, hey, I want to do the application and get the loan estimate. Make sure they know what your goals are. Bullet point number 3. This is really important so they can craft the best program for you. Let them know everything that you plan on moving out in 2 or 3 years, or you plan on staying there for 30 years, or you plan on paying it off before you retire. You're getting cash out. How much cash out? You want taxes and insurance included or not included? Let them know everything so they can craft the best possible loan program for you. And that rolls into bullet point number 4. The loan originator is going to help guide you into what's going to be best for you. A conventional loan, FHA loan, VA loan, USDA loan, whatever it is, but help them out along the way. If you have an FHA loan, let them know in advance if you're trying to refinance an FHA loan. Now, they'll be able to see you have an FHA loan when they pull the credit, but just give them a heads up in advance. It'll help. Same thing with VA. Let them know if you're a veteran and you have your VA loan benefits, and also if you are receiving 10% or more disability. Remember, if you're receiving 10% or more disability, they waive the VA funding fee, or the VA waives the VA funding fee. So that's important. Make sure they know everything about what you're trying to do in the situation that you're in, so they can craft something really good for you. And that leads us up to bullet point number 5. You are going to be choosing the interest rate. Check this out. I'll read it right off from here. Check this note out. You're going to choose the interest rate with the proper break-even point. That is the lowest rate with the appropriate break-even point based on the term, the length of the loan, the situation, or both. For example, you're going to be living in there 1 year, 4 years. Now, just as a quick refresher, we covered break-even, but if you're going to be in there 1 year, you want that loan to break even at that 1 year mark or before that 1 year mark. And then refinance time frame. What I mean by that is, if you're in an environment like we are now, this is in September 2024, we're in a downward rate market right now. Rate pricing is going to be going down. So one technique you can do is refinance with little or no cost. So you don't take a chance on rates going up later. You refinance now into something lower while you can. And then when something lower pops up 5 or 6 months later, you can refinance again. And if you did the initial refinance with little or no closing fees, you don't have to worry about paying for fees again on the second loan. So in a refinance time frame like this, if you're thinking about refinancing when rates are possibly lower in 5 or 6 months, do like a little or no cost loan right now. Same thing with this credit situation here. Now, there are a number of people that have lower credit scores only because they have like maxed out credit cards. They have perfect payment histories and everything else, nothing derogatory. They just have credit cards that are maxed out. That hammers your credit score. And when you consolidate those credit cards, your score should skyrocket. I've done this scores of times for clients over the years, and I did it for myself over 20 years ago. I had like a 667 credit score, perfect payment history and everything on my credit. I just had like 4 credit cards that had high balances on them relative to the limits. I paid those suckers off with a subprime loan, and in a matter of about 40 days, my credit score jumped up to like 747. That was a long time ago, but I still remember. And then shortly after that, 767. And I quickly refinanced into a way better loan with the lower rate and no cost. And that's what I mean by in this credit time frame. So if you're doing a loan and this loan is going to have an positive impact on your credit, you might want to do little or no cost so that you can refinance down the road, maybe 5-6 months later, into a better loan. All right. And you can see in this bullet point here, look at the last point on here, the part of this bullet. Never just choose a rate just because. Never because you heard that it's worth refinancing if you lower your rate 1% or more. That's a bunch of crap there. Or if you just pick out something in your mind like, hey, I want this rate. You don't just pick out a rate for the hell of it. You don't follow that crappy rule of thumb, which is not even true. It's never been true. There's no mathematical reasoning behind it. It's just some urban legend that's been out there for years about lowering it 1% to make it make sense. That's a bunch of crap. You do the math with the loan originator. You put in the work and find out. You choose the best interest rate with the appropriate break-even point. That's how you choose it. You don't just pull it out of thin air. Okay. What is this leading up to? Why do I have you going through these steps? This is leading up to getting what I call your base loan estimate. If you refer to the new notes that just came up here, I'm doing this so you can get your base loan estimate. That's what I call it. You're going to use this base loan estimate to get figures from the other places you are shopping at. It makes it so much more precise, so much easier, and I'll tell you why in a moment here. And don't worry about the loan estimate. In the next section, I'm going to show you how to read it like a boss, like a pro, how to quickly, easily, and accurately read the loan estimate. Okay, I'm going to show you how to do that in the next section. So why all this hubbub about the loan estimate? I think I mentioned that 100 times throughout this course. Why the loan estimate? Why? What's the big deal about getting a loan estimate? Well, check out the notes. Here's the big deal. The loan estimate is no joke. Do not confuse this for the good faith estimate of old. That good faith estimate where the figures could just change and no big deal. No, not with this one. This one doesn't mess around. Look here what I put. There's serious implications for the broker or the lender or the bank that screws up on this loan estimate. We can get fined. I'm talking monetary fines. We can get fined even if we make an honest mistake on this loan estimate. And if the person is stupid enough to try to purposely mislead you with the loan estimate, oh, that's really bad. Not only will you pay huge fines, but you're talking that goes into the realm of license suspension, license revocation. And if they if they discover a pattern of the loan originator being an idiot, you're talking about up to 1 year of prison time. The loan estimate is no joke. That's why when you check out the bullet point number 2 here, the loan originators will take you seriously when you call them up and you say that, hey, I've got a loan estimate here for 5.99 from XYZ lending, and I'm wondering if you can beat the fees on this loan estimate here. They instantly take you seriously when you have a loan estimate. These people that call around a bunch of companies going, what is your rate? What is your rate? A, they know the person doesn't know how to shop properly. And B, they know the person is calling around a bunch of places asking, what is your rate? And they know that that person is probably getting lowballed from all the other places, because they know this person is just calling around asking, what is your rate? So essentially, it's one liar who's competing with another liar, because since they know you're going to, this person, the bad shopper, is going to get on the phone and just ask the next company, what is your rate? They're going to most likely give them some lowball estimate to compete with the other person giving them lowball estimates. The loan estimate takes care of all that business. So if you look in the next bullet point here, the loan estimate makes it easier and possible for you to get a discounted rate. So you're presenting this loan estimate to the other place so they can give you a possible discount on the rate, give you that 5.99% rate for cheaper than the company that gave you that loan estimate. And what you probably don't know, what most people don't know, is that we cannot just lower the rate pricing for the hell of it. Federal laws in place forbid us from offering something to one person and not another person. They want us to give even treatment to everyone. So we can't just lower the rate for the hell of it. There are strict rules that govern where and when we can give a discount. And one of those reasons is for competitive pricing. We can do that if it comes down to competing with another company, but we have to document that. We can't just do it. Every single discount has to be documented. And little discounts, most places can get away with just documenting who the competing company is, et cetera, et cetera. Now, when you start to get into larger discounts, they're going to want some more documentation typically. And the loan estimate, of course, is the perfect weapon for that. When you have that loan estimate, it is no joke. They know you have a real offer, a serious offer, and they're going to try to beat that. Most places are going to do that when you present the loan estimate to them. So it's really, really easy. And there's some places that won't even do it without a loan estimate. That's why I have here in this bullet point, not only does it make it easier, it makes it possible, because with some places it's not even possible to get that discount without the loan estimate. And then when you go into the next bullet point here, I'll tell you what I mean by this. The loan originator can get a tentative go on matching and beating. So a lot of places, just with the loan estimate alone, this is how powerful the loan estimate is. Just with the loan estimate by itself, you can give that to a lender, a bank, a brokerage, whatever, and they can check to see if they can beat that without even pulling your credit, without you even doing an application. That's how powerful it is. They can give you a tentative yes. Obviously, they're going to have to eventually pull your credit, but just to give you a tentative answer, they can do that in a lot of places just with the loan estimate. That's how powerful it is. So in closing, doing it this way just makes it so much damn easier, so much more effective to shop. It is the boss way, the pro way to shop. And I'm going to touch on it a bit more in the next section when I show you how to read the loan estimate like a boss. All right. So this concludes the section on getting your initial quote like a boss. In the following section, the last section in this chapter, we're going to show you how to read the loan estimate and the pro way, like I've been telling you. And I'm going to touch on some of these items here that I just covered in this section, in that following section. Okay. Thank you again for tuning in. Thank you for watching. The next video should automatically play because this is part of a playlist. And if it does not, please jump into the description of this video, access the course outline, and click on the next section. Thanks again, and I will see you shortly on the next video.